Welcome back to the Daily Economy, your daily briefing on markets, money, and the forces shaping our financial world. I'm your host, and today we'll unpack Wall Street's sharp decline, the Federal Reserve's balancing act, and global risks from commodities to shadow banking. Let's get started. Wall Street closed firmly in the red today. The Dow fell 0.47%. The Nasdaq dropped 1.81%, and the S&P 500 lost 1.31%. Tech stocks led the decline, with investors pulling back from high-growth names. Energy and healthcare sectors also weighed heavily. Behind the numbers is a deeper story. Investors are frustrated by delayed economic data releases. Reports on inflation and employment, normally key guides for forecasting, haven't been published on schedule. That leaves traders flying blind, and markets don't like uncertainty. Deep dive, Federal Reserve and labor market, 3 o'clock to 9 o'clock. Now let's zoom in on the Federal Reserve. At its December meeting, the Fed cut interest rates by a quarter point, the third straight cut this year. Chair Jerome Powell emphasized that economic activity is expanding moderately, but job gains have slowed and unemployment has climbed to 4.6%. The highest in 4 years. Economists are calling this a hiring recession. Companies aren't slashing jobs outright, but they're pulling back on new hires. Retail spending was flat in October, following a tiny 0.1% increase in September. That signals households are tightening budgets, even as borrowing costs ease slightly. So what does this mean for you? Mortgages, car loans, and credit cards may see some relief, but tariff-driven inflation is still sticky. Everyday expenses, groceries, utilities, energy, remain elevated. The Fed faces a dilemma: cut rates further to support jobs, or hold steady to keep inflation in check. Analysts expect more cuts in 2026 if labor market weakness continues, but the risk is reigniting inflation. It's a tightrope walk, and households are caught in the middle. Globally, risks are mounting. The Financial Stability Board has warned about the $250 trillion shadow banking market, citing lack of transparency that could sow seeds of systemic instability. Commodities are showing a great divergence. Precious metals and industrial metals are surging as safe haven assets, while crude oil and European natural gas prices are falling due to oversupply and muted demand. Currency markets remain volatile. The British pound weakened on soft inflation data, while the Indian rupee recovered slightly after breaching historic lows against the dollar. And geopolitically, tensions are rising. President Trump ordered a total blockade of Venezuelan oil tankers, escalating pressure on Nicolás Maduro's regime and adding uncertainty to global energy flows. The signature segment, today's number is 4.6%. The U.S. unemployment rate, now at its highest level in 4 years. That single figure captures the Fed's dilemma: support jobs or fight inflation. For households, it means job security is shakier, even as borrowing costs ease. Unemployment has climbed steadily from the low 3% range just 2 years ago. Economists call this a hiring recession. Companies aren't firing en masse, but they're slowing down on new hires. That creates bottlenecks for job seekers and erodes consumer confidence. The danger here is momentum. Rising unemployment often feeds on itself. Cautious households spend less, businesses see weaker demand, and that leads to even slower hiring. Different industries are showing stress. Manufacturing is cooling, pressured by automation and global competition. Retail and hospitality are pulling back as consumer spending flattens. Construction and housing are slowing under higher borrowing costs. Tech is hiring selectively, focusing on niche skills rather than broad expansion. Healthcare remains resilient, but growth is targeted, not expansive. This uneven picture means some regions, especially those reliant on manufacturing or retail, could feel sharper pain than tech-heavy urban centers. Wages are rising, but not fast enough to keep up with inflation. That means households are squeezed. Paychecks don't stretch as far, and essentials like groceries, utilities, and energy remain costly. The risk. Families cut back on discretionary spending, vacations, dining, retail purchases, which slows demand further. That creates a feedback loop. Weaker demand leads to weaker hiring, which leads to weaker demand again. For the Federal Reserve, this is a tightrope. Rate cuts are meant to stimulate borrowing and investment, but inflation tied to tariffs and energy costs remains sticky. Cut too aggressively, and inflation could flare back up. Hold steady, and unemployment could climb further. If unemployment continues to rise, several problems could emerge. Consumer confidence collapse. Households save instead of spend, dragging growth. Corporate earnings pressure. Weaker demand hits profits, leading to more cautious hiring or layoffs. Regional inequality. Rural and manufacturing-heavy areas could see sharper job losses, widening the gap with urban centers. Debt stress. Households already stretched by inflation may struggle with loans, increasing defaults. Political pressure. Rising unemployment often fuels calls for government intervention, which can reshape fiscal policy and trade relations. So here's the takeaway: the 4.6% unemployment rate is more than a number. It's a signal of cautious employers, squeezed households, and policymakers facing hard choices. If the trend continues, we could see weaker consumer demand, rising debt stress, and widening inequality. That's today's deep dive on the daily economy, but this number causes us to dive even deeper with a future outlook at potential unemployment numbers and the scenarios. The baseline current, 4.6%, right now, unemployment sits at 4.6%, the highest in 4 years. It's not catastrophic, but it signals a cooling labor market. Companies are cautious, households are squeezed, and policymakers are walking a tightrope between supporting jobs and controlling inflation. Scenario 1, rising to 5%, labor market. Job seekers face tougher competition, with fewer openings in retail, manufacturing, and construction. Households, confidence dips further, leading families to cut back on discretionary spending. Economy, slower consumer demand pressures corporate earnings, prompting more cautious hiring. Policy response, the Fed likely cuts rates again, but risks reigniting inflation if energy prices stay high. Narration hook, at 5%, unemployment becomes a psychological threshold. It signals to households and investors that the labor market is weakening, even if layoffs aren't widespread. Scenario 2, rising to 6%, labor market. Underemployment grows, more workers settle for part-time or lower-paying jobs. Youth unemployment spikes as new graduates struggle to find openings. Households, debt stress increases. Families already squeezed by inflation may fall behind on loans, raising default risks. Economy, regional disparities widen. Manufacturing-heavy areas see sharper pain, while tech-driven urban centers hold up better. Policy response, pressure mounts on both the Fed and Congress. Fiscal stimulus debates intensify, with calls for job programs or targeted relief. Narration hook, at 6%, unemployment isn't just a number, it's a drag on growth. Confidence collapses, spending slows, and policymakers face mounting pressure to act. Scenario 3, rising above 7%, labor market. Layoffs begin to accelerate, not just slower hiring. Entire sectors, retail, construction, and manufacturing, shed jobs. Households, consumer confidence plunges. Families save aggressively, pulling back on spending across the board. Economy, corporate earnings fall sharply, stock markets react negatively, and recession fears dominate headlines. Policy response, aggressive rate cuts and fiscal stimulus become unavoidable. But inflation risks remain if tariffs and energy costs stay elevated. Narration hook, above 7%, unemployment signals recession territory. The economy shifts from cooling to contracting, and the policy debate turns from prevention to crisis management. Closing insight, so here's the takeaway. Today's 4.6% unemployment rate is manageable, but the trajectory matters. At 5%, households grow cautious. At 6%, debt stress and inequality rise. Above 7%, recession risks dominate. Policymakers, businesses, and families alike should watch this number closely, because it's more than a statistic, it's a signal of where the economy is heading. So here's the big picture. US markets are under pressure from delayed data and Fed uncertainty, while global risks, from shadow banking opacity to commodity divergence, could define the economic landscape in 2026. For households, the compass remains clear. Watch inflation data and energy prices. They'll guide both policymakers and investors in the months ahead. That's it for today's episode of the Daily Economy. Thanks for tuning in, like, subscribe, and leave a comment. Let's stay informed and stay ahead.